It was a day every crypto investor will never forget, a day that would be etched into the collective memory of the financial world. The atmosphere was thick with anxiety, as screens everywhere flickered with red alerts and breaking news. The market, once soaring to new heights and inspiring dreams of overnight wealth, suddenly crashed. In a matter of hours, over $19 billion in leveraged trades were wiped out in just 24 hours, erasing fortunes and shattering confidence. This was more than 10 times the liquidations during the infamous FTX collapse, a brutal reminder of crypto's relentless volatility and the risks that come with chasing quick gains. 1.6 million traders woke up to find their accounts emptied overnight, their borrowed money forcibly sold off by exchanges in a wave of margin calls. For many, it was a devastating blow that would take years to recover from. The total crypto market cap plunged by $560 billion, as if the entire economy of a small country had vanished in the blink of an eye. The shockwaves rippled far beyond crypto, shaking global markets and investor confidence everywhere. Most of the losses, $16.7 billion, came from long positions, as overconfident traders who bet on the market's rise were caught completely off guard. Hopes of quick profits turned into staggering losses in minutes. Behind the scenes, automated trading systems and bots kicked into overdrive, triggering a cascade of sell orders that accelerated the crash and left chaos in their wake. The speed and scale of the collapse stunned even the most seasoned professionals. All of this was set in motion by a single political announcement, one that sent panic through every financial market on the planet, proving just how interconnected and fragile the world of crypto truly is. The spark? Geopolitics. Tensions between the United States and China had been simmering for years, but this time, the stakes were higher than ever. The world watched as diplomatic relations frayed and economic threats turned into concrete action. Former President Trump announced a sweeping 100% tariff on all Chinese imports, set to take effect in November 2025. This move sent shockwaves through global markets, signaling a dramatic escalation in the ongoing trade conflict. This wasn't just a policy tweak, it was an economic war declaration between the world's two largest economies. The message was clear. The era of cooperation was over, and a new phase of confrontation had begun. The news shattered market stability, especially after the US also imposed new export controls on critical software. Investors and analysts scrambled to assess the fallout, as volatility spiked across every major index. Investors panicked, fleeing risky assets. The uncertainty was palpable, with many seeking to minimize exposure to anything remotely volatile. Crypto, being the riskiest, was hit hardest. Bitcoin, Ethereum, and altcoins all saw their prices nosedive within hours, as traders rushed to liquidate positions. When uncertainty spikes, big money runs to safe havens like the dollar or gold, not Bitcoin. Traditional assets suddenly looked far more attractive than the digital alternatives. The tariff news triggered a perfect storm for a crypto sell-off. Panic selling swept through the market, amplifying losses and deepening the sense of crisis. This event exposed crypto's vulnerability. Despite claims of decentralization, it's still tied to global economic shocks. The myth of crypto as a safe haven was shattered in real time. Bitcoin, Ethereum, and all coins remain at the mercy of macro events and institutional capital flows. Their fate is intertwined with the broader financial system, no matter how independent they seem. As long as crypto is traded on global exchanges and valued in fiat, it's not immune to the world's fears. Every headline, every policy shift can send ripples through the digital asset market. The trade war was a stark reminder. Crypto is part of the global financial system, for better or worse. In moments of crisis, its fate is tied to the same forces that move the rest of the world's markets. The real culprit behind the massive losses, leverage. It's a powerful tool, but also a dangerous one, especially in the hands of overconfident traders. When markets are rising, leverage can make you feel invincible, multiplying your gains and fueling dreams of quick riches. Leverage lets traders borrow money to amplify bets. Great in a bull run, disastrous in a crash. It's like playing with fire. The rewards can be huge, but the risks are just as big, if not bigger. Many traders, lured by the promise of outsized returns, ignored the dangers lurking beneath the surface. With 10x leverage, a 10% drop wipes out your entire investment. There's no room for error. One wrong move and your position is gone in an instant. Many were using 20x, 50x, or even 100x. The higher the leverage, the thinner the margin for survival. It was a high-stakes game, and the odds were stacked against the players. Perpetual futures made it easy to keep these risky positions open indefinitely. There was always another chance to double down, to chase losses, or to bet even bigger. The market was a ticking time bomb, propped up by overconfidence and borrowed money. Every new bet added more pressure, making the system more fragile with each passing day. When the trade war news hit, prices fell, triggering liquidations for the most leveraged traders. Panic spread quickly as automated systems began selling off positions to cover losses. Each forced sale pushed prices lower, causing more liquidations, a chain reaction. The market became a self-fulfilling prophecy of fear and loss, with each drop accelerating the next. A 5% drop could wipe out 20x leverage, a 2% drop, 50x. The smallest tremor could trigger an avalanche, wiping out fortunes in seconds. The result, a catastrophic cascade, as the market's own mechanics turned a crack into a dam break. What started as a small slip became an unstoppable flood of losses. Billions vanished in hours, all because traders bet too big on endless gains. The dream of easy money turned into a nightmare almost overnight. The lesson? Leverage magnifies both profits and losses, often with brutal speed. It's a double-edged sword that can cut deeper than most ever imagine. In crypto, the higher you fly, the harder you fall. And when you fall, leverage ensures you hit the ground even faster. Panic swept the entire crypto market. No asset was spared. Bitcoin plunged from $125,000 to $102,000, with 5.3 billion in leveraged positions liquidated. Ethereum crashed from over $4,300 to $3,373, erasing weeks of gains and $4.4 billion in liquidations. Solana, XRP and Dogecoin all suffered double-digit losses, with Solana alone triggering $2 billion in liquidations. Smaller altcoins and DeFi tokens saw flash crashes of up to 90% in minutes. The most shocking, a single $87.5 million Bitcoin position on HTX was wiped out instantly. The carnage was total. Fortunes lost in the blink of an eye. The message was clear: in a true panic, nothing is safe. The initial drop was just the first domino. Cascading liquidations turned a correction into a meltdown. Each forced sale triggered more, overwhelming buy orders and accelerating the fall. Trading bots programmed to react instantly dumped assets at lightning speed, amplifying the chaos. This feedback loop of automated selling created a downward spiral with no bottom in sight. Even stablecoins showed cracks. Ethereum's USD briefly lost its dollar peg, a red flag in a supposed safe haven. The system's complexity and speed, usually strengths, became weapons of destruction in a panic. Billions were erased before anyone could react. The meltdown wasn't caused by one thing, but by the interplay of leverage, automation, and fear. In crypto, efficiency can turn deadly when panic takes hold. While millions lost, one anonymous whale on Hyperliquid made history. This trader built a massive short position before the crash, borrowing and selling thousands of Bitcoin and tens of thousands of Ethereum. When prices collapsed, their bet paid off, an estimated $190–200 million profit. The timing was so perfect, some suspected insider knowledge. Whether luck or skill, the whale's trade was a masterclass in profiting from panic. For every liquidation, there's a winner on the other side. The billions lost by many were pocketed by a few who bet against the crowd. In crypto, legends are made in moments of chaos, After the crash, experts are split. Some warn of more pain ahead. Liquidations can create hidden risks, like firms unable to pay lenders, leading to further failures. Others see the crash as a healthy reset, flushing out reckless leverage and leaving the market on firmer ground. Evidence supports the optimists. Bitcoin and Ethereum held key support levels, and institutional investors bought the dip. Still, confidence is shaken. The market faces weeks of choppy, sideways action as it regains its footing. The easy money is gone, replaced by caution and uncertainty. Was this the start of a bear market or just a brutal shakeout before the next rally? No one knows for sure. What's clear, the crypto market is forever changed. The only certainty is uncertainty. The future of crypto hangs in the balance. Geopolitical tensions, especially the US-China trade war, could trigger more panic at any moment. But there are bullish catalysts. If the Fed eases monetary policy or if new ETFs attract institutional money, the market could rebound. Many analysts expect a period of consolidation, sideways trading as bulls and bears battle for control. Volatility will likely subside, but the road ahead is bumpy. History shows markets can recover and make new highs, but patience is key. Investors must watch global events and policy shifts closely. In crypto, the only constant is change. The meltdown was a harsh lesson for all. Rule 1: avoid leverage. Unless you're a pro, it's a fast track to ruin. Stick to spot investing. Buy coins with your own money, not borrowed funds. Use dollar cost averaging. Invest a fixed amount regularly to smooth out volatility. Think long term. If you believe in crypto's future, don't panic sell during crashes. Only invest what you can afford to lose. Never risk rent or retirement money. Diversify. Crypto should be just one part of your portfolio. Stay humble, stay patient, and don't chase quick riches. Volatility is part of the game. Embrace it, but don't let it control you. In crypto, survival is the first step to success.